Good afternoon from the Shreveport office of Eagle Financial for the latest edition, the August 12th edition of the Jack and Bill Show. Bill is out this afternoon. We've had an enormous rally ongoing since the last time we did this. I think we sat in the chair here 2 weeks ago and we talked about Goldilocks. That is news that's not too bad, news that's not too good, news that's actually a little bit bad that would prevent the Fed from tightening dramatically from here or more than expectations that are baked into the stock and bond markets. So my colleague sitting behind my desk back there just asked me if I was going to tell everybody that inflation is over. And where 2 weeks ago we talked about Goldilocks, this week we're going to have to talk about what this recent rally is about. And we've entitled this, I think we have, the soft landing rally. And what that means is that there is no recession in sight. So you've probably heard us say this before, or I'm going to say that's what the market has discounted the last 2 weeks, that the Fed has everything under control. Earnings are looking pretty good right now. Market prognosticators, economists, and Wall Street analysts are predicting earnings growth for the rest of this year and next year. So that's really kind of high expectations for the market. At the same time, we had economic news this week that was a continuation of the good news that we had last week. Okay. And the good news 2 weeks ago, rather, the Goldilocks news 2 weeks ago was a second quarter in a row of declining GDP growth, which depending upon what news network you watch, this set off a firestorm of political bantering back and forth, the right saying that we're in a recession and the left actually redefining what a recession is. That's not really fair because I don't think I would argue that we're in a recession, right now with barely declining GDP sequentially for the last 2 quarters. So here it is. This week is the news. Recall that 2 years ago when we were coming out of the pandemic with supply chain disruptions, we started to see inflation bumping up. It's been 15 months, 18 months, something like that. Early the spring of 21, we started seeing inflation, which Janet Yellen referred to the result of, she used the word, invented a term, transitory, and based it on supply chain disruptions. So here's where we are now. The producer price index, which is wholesale goods, came out. That number came out yesterday, and it had been up 11.3% inflation over the prior 12 months. We call that year over year inflation. It came out this Thursday at 9.8% inflation. And that came a day after the consumer price index, the most closely followed inflationary index, came out at 8.5%. Now, I think both of these numbers were improvements from analyst expectations. They were certainly improvements, but I'd like to put this into context of reality. So, Wesley, here's the answer to your question. Is inflation over with? We can just leave this to the viewers, but listen to these two statistics. Okay. Most of what we read about, when you read in the headlines today about yesterday's PPI numbers, you want to look at it. We want to measure it every way possible, but most economists look at it the year over year, are we better off now or worse off now versus a year ago? And then month over month kind of gives you a more timely trend or trend analysis. Okay, the PPI number had gone up 26 months in a row. That's month over month, same thing. 26 increases in inflation in a row. And yesterday we had a reported monthly decline of 0.5%. Okay, on the CPI, which came in at 8.5% year over year, we actually came in flat. So we did not have a month over month increase or a month over month decrease. But these two numbers this week were Goldilocks for the market. So we had huge advances in the market, which has been a continuation of last week. And there's a Mr. Grant, who is I'm not sure if he's still with B. Riley anymore. I think he's still with B. Riley. Anyway, he says if you combine the 8.5% CPI with the 9.8% PPI and divide that by 2, that's a true indication or a pretty good indication of what kind of inflation we're experiencing. Of course, there's these economists or conspiracy theorists, some might say, that would say that there are shadow economics, shadow inflationary numbers that are much higher than that. But if I add those two together and divide by 2, we still get 9.15% inflation is about where we are right now. Is it slowing? I'm going to argue, Wesley, it's too soon to tell. I mean, the CPI month over month did not slow. It was flat. And I read an interesting report from this young rock star analyst out of Hungary, who's basically said that, inflation may come down a little bit now, but it's going to stay elevated for quite some time, because what we're seeing in the inflationary numbers is not transitory, not from completely from supply chain disruptions. Some of those going away, some of those are not, but rather it's systemic and baked in, and it's here to stay. And some of that is the very low unemployment numbers of those ticked down to 3.5%, which puts upward pressure on unit labor cost increases. So if you're a small business owner and you want to hire somebody, there are 2 job openings right now available for every worker bee out there. So if you want to get really good help, you likely have to bid up the price of labor to get them and retain them. I just read in today's Wall Street Journal, for example, there's a shortage of pharmacists, and the pharmacy industry, I think it was CVS, I read, is that actually it's Walgreens is offering signing bonuses of up to $75,000 to pharmacists in some markets, as they've got chronic worker shortages. This is highly inflationary. I mean, imagine having to pay, $75,000 to get someone to commit to, a couple of years' work. So essentially, where does this put us in the scheme of things, and what does this do with our expectations, or what to do about all this? And with regards of what's really been going on. Okay, so we started off the year in bad shape with both stocks and bonds. Cut it with a meat axe, down roughly 5% for the first quarter, and both stocks and bonds. So there was nowhere to hide. Maybe in commodities you could hide there, and then that downturn accelerated with both the stock and bond markets through about, call it June the 15th or 16th, 17th, thereabouts. And then we've had, given where we went today, and I'll just tell you what happened today. I looked at this with about 5 minutes prior to the close. S&P 500 having a gangbuster day, up 1.7%. The Dow up 424 points just prior to the close, or 1.27%. Those are blue chip industrials, 30 names. The NASDAQ market, which is way more sensitive to expectations about what Jerome Powell and the Federal Reserve are doing, it was up 2.1% today and has rallied really sharply, but coming off of a 35% decline through year to date through June the 17th. So since then, Wesley, would you want to make a guess how much we've rallied since mid-June? No. Okay. The S&P 500, the most widely indexed, 500 large companies in America, capitalization weighted, it's up nearly 18%, call it 17.7% coming off of mid-June. So we've had a very sharp rally really over the last, 2 months. I mean, not quite 2 months. Middle of June, it's middle of August, will be when we come in here Monday. Up 17.7% in 2 months. This again is more Goldilocks. Markets discounting that even though the Fed, we've had 13 tightening cycles since World War II, the Fed has put us into recession 10 of those times. With recession beginning the shortest time period, 10 months after the first tightening, which we got in March. So, and this is not just stocks. This is the things that have gone up the most are higher valuation names, lower dividend paying names, those that are more sensitive to changes in interest rates, very much like a long dated bond. The bond market has rallied at the same time. I was looking at one of the largest, most widely held open-end mutual funds called the Dodge and Cox Income Fund, and it's rallied between 3 and 4% since the middle of June, which is a really, really strong rally. So, so this is what we should say in conclusion. I just wanted to say hello. We've had very volatile markets. If you think about this, you would think that given what's happened in the last 2 months, that things are normal. Things are far from normal. We have a war that's raging right now with fears. I guess these fears have subsided that this thing going on in Ukraine is limited and not so bad. This is a picture of today's Wall Street Journal that actually front page, I might add, of Crimea, where these fourth or fifth generation Soviet fighters were blown up on August the 10th. Putin denied this, and here's the satellite imagery showing busted up aircraft all over the runway. So the war is still going on. This is a really horrific thing. If you're a resident of the Ukraine, U.S. estimates are that upwards of 85,000 Russian troops and unbelievable amounts of tanks and aircraft and equipment have died and been destroyed. And so I think we can expect more volatility to come. And the Fed is not over with. I think what this news this week and the GDP numbers news has given us is that the Fed is likely, the markets are discounting now a 0.5% hike in the next meeting, which is mid-September, versus the last two hikes. So the Fed funds rate is now 2.25 to 2.5 in that range. We're likely going to see it bumped up 0.5% in September. But keep in mind, this is data dependent. There's a whole lot more information forthcoming, a lot more data forthcoming to Jerome Powell and the Fed. And according to Jerome Powell, he's way more focused on inflation than he is how the economy's doing. So, there's definitely political pressure on him to take care of both, hopefully at the same time. But the jury is still out. I think we're definitely going to see more volatility with the news of the day. The Fed is certainly not done tightening, unless something catastrophic or geopolitical were to occur. And but we want to ride this wave while it lasts. It's a good time to look through your portfolios, look over your portfolios, have a professional like us. I might throw this out too. I'm concluding here. If anybody has a question, write in, and I'd love to field it for you. But if you started out the year, for example, 50-50 stocks and bonds, or 50% stocks and alternatives and 50% bonds, now would be a really good time to rebalance again. We've been rebalancing through the year, into equities and out of fixed income. And now might be, if you've rebalanced and you're overweight equities again, it might be a really good time to take money off the table. I'd be inclined to say, we'd rather own the blue chips and industrial type names, what we call value stocks or low PE stocks, low price to earnings ratio stocks, low price to earnings ratio versus growth rate stocks. We look at that. That's called the PEG ratio. Anything under 1.25 or under 1 would mean that's a very good valuation given the growth of the company. So we like that which is scarce, which is dividend income with common stocks. The same with the bond market. Definitely the bond market has more opportunity right now with what the Fed has done since March. That's another advertisement to throw out there. If you've got money sitting in the bank earning, 0.2%, I don't think I have a Chase checking account, and I don't think I get 0.1%. I don't know, but any large cash balances, you could easily be getting 3% on that money right now in the highest quality securities, and really not tying it up long at all. So if anyone has any questions or would like a portfolio review, it is a good time to be rebalancing, to check your portfolios, and especially if you're overweight equities, be a great time to trim some of that with the run-up that we've had. Don't really have any sports news today, other than I've been excited kind of watching the Little League World Series, which is held in Williamsport, Pennsylvania. I think there are 20 teams from all over the United States representing their state that are about to invade Williamsport. And that's been exciting watching them. We haven't had this for 2 years due to COVID, and international teams are playing as well. But last night kicked off the first of preseason football. My wife is really excited about watching our Saints this year, and that's about it. Any questions back there, Wesley?
That's a negative.
Okay. Hopefully we will see you next Friday, and thank you for watching. Have a great weekend and be safe. Peace out.